give us a sense that how much has the liquidity improved in the banking system after the recent RBI measures? Because just tomorrow, yes, indeed, you did share your expectations from the policy meet, and the commentary will also be what we'll be looking out for. But in terms of the liquidity positioning for the banking sector, has anything improved incrementally or substantially?
See, the measures that have been taken up do address a part of the liquidity deficit. Total amount that is supposed to be added through the measures that were taken up last month was about 1.5 trillion rupees, but the deficit at that time was tracking at about, much higher than that, about 2.5 to 2.7 trillion. So it does address a part of that liquidity deficit issues, but probably as we go into further into especially March end, with you'll have advanced tax outflows, yes, temporary issues, but they do squeeze liquidity. So in that context, we do think that probably some more in line of those previous measures, like either OMOs or FX swaps, combination of those or longer term VRRs would still be needed to just ensure that financial conditions don't tighten materially. So with those liquidity measures, yes, there has been some improvement in terms of the overnight call rates, but probably you need to do a little bit more so that you don't you avoid the preemptive tightness in financial conditions if there were no measures taken up, especially given the seasonal factors are stacked against liquidity in the next few weeks.
I was reading your report, Upasana. Interestingly, you did mention the fact that about a stance on the Indian equities, where you're saying you remain constructive on the Indian equities. But what actually struck over there is that you have bias towards the SMID over the large caps. So, given the current valuation gap, do you think now is the time that you can look at these counters in the small and the mid cap space? And especially when you talk about that, is it more tilted toward the consumption side or the capex theme?
So that's our view of our strategist, Rhythm Desai. Yes, he's biased towards, as you mentioned, these sectors. We do think that given where we are, and I'm just relaying his views over here. There is probably more scope in terms of private sector financial, large private sector financials, and also consumer discretionary themes, especially with the budget that has come through. On the industrial side, we do think that overall longer term, the industrial theme, even from a macro or an econ perspective, does sustain. Probably there would be some rejig in terms of the subsector themes in the industrial side, given how the budget allocations have moved, as we discussed earlier. Budget allocations or the ministry-wise spending has changed. Roads, rails are largely flat. There's been higher allocation across some other other ministries such as housing, defense, etc. So there would be probably need to rethink at the sub-segment level on the industrial space.